Assalamualaikum warahmatullahi wabarakatuh. I am Hidayatul Shuhaida and we are going to present about Top Glove and Hartalega financial statement comparison. Top Glove Corporation Berhad, a Malaysian company founded in 1991 by Tan Sri Dr. Lim Wee Chai, specializes in rubber gloves, face masks, dental dams and related products. Starting with a single production line, it has grown to become the world's largest glove manufacturer, holding 26% of the global market. The company operates 50 factories across multiple countries and has marketing offices worldwide. Listed on Bursa Malaysia in 2001 and the Singapore Exchange in 2016, Top Glove expanded its portfolio by acquiring Aspian Sendirian Berhad in 2018 and entering the condom business. It saw significant growth during the COVID-19 pandemic, with a 400% profit surge in 2020 due to high demand for protective gear. By 2021, it managed 812 production lines, exported to 195 countries, and served 2,000 customers. As of February 2022, it reported a shareholder fund of RM 6.95 billion and quarterly revenue of RM 1.45 billion. Now let's move to the financial statement of the company. To analyze this financial statement, we will look at various key financial ratios and trends from the data provided. Here's a breakdown of the most notable trends and aspects. For the total assets have decreased from 2021 to 2023 by approximately 2.7 billion. The peak was in 2021, which was likely influenced by an increase in current assets and investment securities in that period. Non-current assets are long-term assets including property, plant and equipment, PPE, investment properties and intangible assets. PPE has been significant contributor to the non-current assets, but it saw a decline from 2022, which is 4.5 billion, to 2023, which is 3.89 billion. Right-of-use assets and investment properties have generally increased, with investment properties growing significantly from 227,400 in 2022 to 419,699, which is in 2023. And so goes to the intangible assets have declined considerably from 1.26 billion, which is in 2019, to 864,465 in 2023. For the current assets, which are short-term and include inventory, receivables, and cash, saw large fluctuations. Inventories significantly declined from 1.14 billion in 2021 to 301,496 in 2023. Trade and other receivables followed a similar pattern, with a notable drop from 566,299 in 2021 to 182,622 in 2023. Investment securities, both money market funds and debt securities, fluctuate significantly, with money market funds increasing sharply in 2023 at 630,186. Cash and bank balances decreased from 878,446 in 2021 to 285,416 in 2023, which could be a sign of liquidity challenges or larger capital expenditures. Next, we move to the liabilities, which is loans and borrowings increased notably in 2023 to 540,356 from 306,122 in 2022. We take a look at trade and other payables have fluctuated but overall have been significant, especially in 2021 and 2020. Contract liabilities saw a large decrease in 2023 from 216,565 in 2022 to 102,995, indicating a reduction in future obligations. Income tax payable is quite low, especially in recent years. Next, we move to equity. The report doesn't include a detailed breakdown. So for the net current assets, it has been positive in 2019. However, in 2020, the figures are dropped to negative 53,100, which indicates a liquidity issue during that period. However, in 2023, the net current assets are positive again at 764,158, showing an improvement. So for the investment strategy and market risk, the company holds substantial investment securities, both debt and money market funds, indicating a balanced or conservative approach to market risk. The drastic change in these assets, especially the surge in money market funds, might suggest the company is taking a more cautious stance in 2023 amid external market uncertainties. The trend observation, property, plant and equipment steady increase then decrease in 2023. Intangible assets declined since 2019, possibly due to amortization or impairment, and the current assets fluctuation due to changing level in receivables, inventories and cash. So what I can conclude here, the company's financial performance and positions shows a mixed picture. The total assets and non-current assets has been decreasing recently, particularly in 2023. Liquidity appears better in 2023 than in 2020, with positive net current assets and a solid current ratio. However, the decline certain asset like PPE or intangibles could be concerning and may indicate the company is reducing capital expenditures or facing challenges in growing its asset base. The increasing borrowings and fluctuating liabilities could also suggest potential financial stress, although the current assets are sufficient to cover short-term obligations. So for the deeper analysis, the income statement and cash flow statement would be needed to be better assess profitability, cash flow, and overall financial health. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nidno Syafiqah binti Muhammad Yusof, and today I would like to present about a vertical and horizontal analysis for Top Glove Company. In order to make an analysis in vertical and horizontal for this company, we need to make sure about the revenue growth, gross profit margin, operating expenses, and net profit margin. In this 4 points, it's really hard to make a vertical and horizontal analysis. Number 1, revenue growth. Top Glove experienced significant revenue growth during the COVID-19 pandemic in 2020 and 2021, reflecting increased global demand for gloves. The second one is gross profit margin. The gross profit margin peaked in 2021 at 30%, coinciding with higher demand and pricing power. However, it declined in subsequent years as market conditions normalized. Number 3 is about operating expenses. Operating expenses remain relatively stable as a percentage of revenue. indicating effective cost management despite fluctuation in revenue. And the last one is about net profit margin. The net profit margin follow in similar trend to the gross profit margin, peaking in 2021 and then declining. In 2023, the company reported a net loss, indicating in challenges such as increased competition, higher raw material costs, or reduced demand. In order to make a vertical and horizontal analysis, we need to overcome a financial statement in a year 2019 until 2023. Vertical and horizontal analysis involve expressing each item in financial statement as a percentage of a base figure, facilitating the assessment of relative proportion and trends over time. Below is the financial statement from year 2019 until 2023 for Top Cloth Corporation Berhad Company. Top Cloth Corporation Berhad income statement for the fiscal years 2019 through 2023, which each item presented as a percentage of a total revenue of the year. Okay, as we can see in the table below, the vertical analysis expresses each financial statement item as a percentage of a base figure. In this case, from year 2019 until 2023, the sale for each year is 100%. This is the base for comparison. For cost of goods sold, COGS, a major component of expenses. COGS show increasing percentage from 2019, which is 70.5% to 2023, 97.60%, indicating that production costs rose significantly relative to sales. For gross profit, which is 2.89% in 2023, down from 39.4% in 2020. Gross profit margin drastically declined over the years due to higher costs eating into revenues. For other components, which is, for example, operating income, net profit declined sharply from 24.7% in 2022 to negative 39.23% in 2023. The figure in 2023 years reflect a challenging financial position, likely due to reduced demand or increased competition. For horizontal analysis, compare trends in financial data over time, highlighting trends and growth rates. For sales growth in horizontal analysis, 2023 are 147%. In year 2022 is negative 14%. Sales increased significantly in 2023 compared to the prior year, by decline in 2022 showing violetly. For COGS growth, which is 110.9% in 2023, costs increase outpace sales growth, which negatively impact profitability. For gross profit in horizontal analysis, in 2023, we can see negative 39.89%. A subsequent decline indicates shrinking profit margin. For operating income and net income, in 2023, there was a sharp decline in operating and net income, showing negative growth trends and potential operational if not previously. So, the takeaways key that we can take here is the rising COGS relative to sales has significantly altered profit margin. For the revenue fluctuation highlight market and operational challenge, especially post-pandemic. Negative trend is profitability. Horizontal analysis show declining net income over time, with 2023 indicating several challenges.
For ratio analysis, first one is liquidity ratio. There are three particular in liquidity ratio, which is current ratio, quick ratio, and cash ratio. In current ratio, as we can see from 2019 to 2023, the current ratio generally improved. The significant jump from 0.97 in 2019 to over 2.0 in the next year indicates that the company significantly strengthened its ability to meet their short-term obligation. For quick ratio, it is also improved from time to time. In 2019, the ratio is 0.58, and in 2023, the ratio is 1.5. Compared to base, it is a higher increase in quick ratio rate. The increase from 2019 to 2020 reflect the operation efficiency and stronger liquid asset. For cash ratio, based on the data, Top Glove has strengthened their cash equivalent to pay their current liabilities by using cash. For every RM1 of liability, how much the company can pay it by using cash in hand. The increase pattern is start from 2020 and declining in 2023. For Hartalega, compared to Hartalega, from the table, Hartalega current ratio in 2023 is higher than the Top Glove overall rate, but this is due to the number of plants that this company have and competing in many industries. Based on study, the ratio rate above 3 is considered inefficient as it fails to manage their asset efficiently. For Hartalega quick ratio, the company is holding too much liquid asset as it over 6 times rate. The company is considered solid when the ratio is around 1 to 1.5. For cash ratio, the company also holding too much cash. As for RM1 of liability, they can pay it 4 times the amount of debt. All this extra liquid asset can be used to expand their business. For profitability ratio, based on the overall margin and return, we can see a trend where during pandemic COVID-19 in 2020 until 2022, during COVID-19, Top Glove has made a higher return on all of the profitability ratio, and in 2023 the trend has come to an end where the return and margin has entered negative margin and return. Same goes for Hartalega. In 2023, they also suffered from the post-COVID-19 effect where the company recorded a loss in their ratio, which is efficiency ratio. For Top Glove, average collection period throughout the 5 years has been good, as it have liquid asset within 60 days. They can pay their short-term obligation in less than 45 days throughout the 5-year period. Compared to Hartalega, the collection is much higher compared to Top Glove in 2023. For inventory turnover, looking at 2019 and 2023, it seems like the company has come to normal turnover rate. During 2020 until 2022, the company high turnover rate is due to the pandemic COVID-19, while Hartalega is able to maintaining a high selling rate from 2020 until 2023. For receivable turnover ratio, looking at the base rate in 2019, the company has increased their receivable collection for the company in 2023, while in 2021 until 2022, it is low due to the pandemic COVID-19, where many companies and agencies might face difficulty in paying their obligation. Top Glove also have given them a flexibility in making payment. For Hartalega, the collection for Hartalega is low due to its vast market and industry. For fixed asset turnover, the fixed asset turnover for the company is good as it efficiently using their asset to generate income. Compared to 2023 to 2019, the company might have expanded their business and the rate as it show a slight decline, while Hartalega is good in utilizing their fixed asset to convert them onto revenue. The last one in efficiency ratio is total asset turnover. The declining trend in the total asset turnover for Top Glove reflect the company's lack of ability to convert their usage of asset to revenue. In 2021, the company recorded the highest turnover, while in 2023, the company recorded less than their base 2019 turnover, which is 0.32 times. Compared to the current year, For Hartalega are gaining higher revenue rather than the top glove revenue in 2023. The last ratio analysis section is financial leverage ratio. Therefore, particularly, it is total debt ratio, debt to equity ratio, and time interest earned. For total debt ratio, Top Glove is good in managing their debt as the company reduced their debt from 2020 until 2023. The ratio reflects the amount of debt that the company bear in their organization. As we can see, for Hartalega, it is much more efficient in managing their debt ratio as in 2023, it's still below 10%. For debt to equity ratio, for every RM1 of shareholder equity, there is amount of debt that they need to pay. In 2019, it replicates that their shareholder is facing loss and they reduce their debt to equity ratio from time to time. Comparing based to the current year, 2019 to 2023, it shows that the company is managed to increase their shareholders' margin. For Hartalega, they has a much lesser debt for their shareholder equity. For equity ratio, the amount of shareholder that the company gain from time to time is remarkable as it increased every year, but during 2023, it is considered too high as the company need to pay 84% for every 1 ringgit of profit they gain. And for Hartalega, they also need to lower their equity ratio as they need to pay 87 cents for every 1 ringgit profit that the company made. The last one is time interest, and the company is facing net loss in the recent year. For the past few years, the company has been doing great in making sure that they have gained their net profit. Same goes for Hartalega, they also facing net loss in the recent year and have been a remarkable company for the past few years.
Assalamualaikum madam, my name is Muhammad Akil bin Yusri and my ID number is 2022109861, and today I will talk about data visualization. If we examine the graph of revenue, profit, earning per share, EPS and stock price movement, Hartalega has shown a smoother upward trend over the year, especially after 2021. In contrast, Top Glove has displayed more volatile or decline trend, particularly post-pandemic. This indicates that Hartalega is better positioned to weather market fluctuation and maintain a long-term growth. Okay, next I will present an analysis of two major companies in glove industry, which is Top Glove and Hartalega. My goal is to help determine which company is more worth investing in based on their financial performance from 2019 to 2023. To do so, we will focus on four key types of financial analysis, which is horizontal analysis, vertical analysis, ratio analysis, and data visualization. Okay, let's begin with horizontal analysis. This method compares financial data across multiple periods to identify growth pattern and potential challenge. For the Top Glove, we noticed that the company performed strongly during the pandemic, seeing a surge in revenue and profit. However, as the pandemic end, its growth starting to decline in 2021 and beyond. This slowdown could be sign of market saturation, increased competition, or higher production costs. On the other hand, Hartalega has experienced steady growth in revenue and profit margin, even as the global demand for glove normalized. While it too saw a spike in demand during the pandemic, its ability to maintain consistent growth afterward indicate a more stable long-term trajectory. Okay, we moving to the vertical analysis, which is express each financial item as a percentage of base item like revenue. This help us as a company operation efficiency. Okay, first for the top graph, percentage of the gross profit is consistently high compared to operating expense. It will signal good operation efficiency. However, a heavy reliance on sale volume rather than value-add product could expose the company to risk. For the Hartalega has generally shown the higher propor- proportion of profit relative to revenue, suggesting greater efficiency and better cost control. If Hartalega gross profit margin consistently outpace Top Glove, it could indicate that Hartalega is more efficiency in managing its operation and produce glove at a higher profit margin. Okay, next, we will do the ratio analysis where we analyze key financial ratio that show the profitability, liquidity, efficiency, and softness uh, of the companies. Okay, starting with profitability ratio, such as net profit margin and return on equity. Top Glove has seen a decline in this ratio post 2021. This suggests that the operation efficiency and profit margin have been under pressure. For the Hartalega, has maintained higher profitability ratio throughout the same period. A higher ROE and net profit margin indicate that Hartalega has managed and maintained a stronger profitability despite the challenge faced in industry. Okay, when we look at the liquidity ratio, which assess the company ability to meet the short-term obligation, both companies should ideally show a healthy liquidity. However, if one company has significant stronger liquidity position than the other, it can reduce risk of financial distress. Companies with the highest liquidity are less likely to face softness issue, so this key factor is assessing investment risk. Next, efficiency ratio like asset turnover and inventory turnover. Hartalega higher efficiency in this area suggests it use it resource more effectively than Top Glove, which could make it more attractive investment. Then finally, solvency ratio like a debt to equity help assess the level of financial risk in company. A lower debt to equity ratio is preferred by investor because it indicate less reliance on debt to financial operation. In conclusion, when we combine all these analysis, Atalega emerged as the better investment for the following reason. First, the higher and more stable profitability. Talaga has consistently outperformed Top Glove in profitability ratio, indicating better financial health. And second, better operational efficiency. Talaga has been able to generate higher profit with better cost control, demonstrating strong operational capability. Third, lower financial risk. Hartalega lower debt level and higher liquidity suggests it is less risky investment compared to Top Glove. The fourth is sustained growth. Hartalega has shown the consistent growth even after the pandemic, which suggests it's more adaptable and resilient in the face of changing market condition. While Top Glove had impressive performance during the pandemic, it post-COVID challenge, such as volatile profit, declining margin, and higher reliance on debt, make it riskier investment in the current environment. Therefore, based on uh, our financial analysis, Hartalega is more attractive option for long-term investment. Thank you. That's all from me.